This is no longer a diversified mining story. Anglo American is becoming a concentrated copper and industrial metals bet, and that completely changes how investors should look at the stock. The problem is not that the business is collapsing. The problem is that the market is already pricing in a near-perfect future driven by copper optimism, restructuring success, and merger upside, while the company still has weak structural economics and no real moat. The business is recovering, but unevenly. Revenue collapsed from $30.6 billion in 2023 to $17.7 billion in 2024, then modestly recovered to $18.5 billion in 2025, with forecasts pointing toward stronger growth into 2026 to 2029. EBITDA dropped hard, then began improving, while adjusted net income fell sharply to just $610 million in 2025. Free cash flow was deeply negative in 2024 and 2025 before expected recovery. So this is not a stable compounder. It is a cyclical miner trying to rebuild earnings power while depending heavily on commodity prices, especially copper and iron ore. That matters because investors are paying for recovery before recovery is fully proven. The stock looks expensive. Morningstar's fair value estimate is 2,200 GBX, versus a market price around 3,515 GBX, implying roughly a 60% premium. That means this valuation only makes sense if copper prices stay elevated for longer, restructuring materially improves profitability, and the tech merger creates stronger long-term economics. Current business quality does not justify this multiple on its own. Investors are not buying Anglo as it is today. They are buying a bullish commodity future. Anglo is intentionally shrinking into a more focused metals company. After rejecting BHP pressure and restructuring, it is moving away from diamonds, platinum, and other non-core assets to focus on copper, iron ore, and crop nutrients, while the tech merger would make it one of the largest copper miners globally. Strategically, this is logical because copper has stronger long-term electrification demand. But it also makes the business more concentrated and more exposed to one macro thesis. If copper weakens, the entire story weakens. Anglo is competing against giants like BHP, Rio Tinto, Vale, and Teck. Its strongest assets are long-life copper mines like Quellaveco and Collahuasi, which sit relatively low on the cost curve. That gives it credibility. But in iron ore, it is structurally weaker than BHP, Rio, and Vale because of higher costs and logistics disadvantages. It does not have a durable moat, which matters because commodity businesses live or die on cost positioning and operational discipline. Anglo has some good assets, but it is not the strongest operator in the field. The biggest risk is simple. Copper optimism breaks. If copper prices normalize toward mid-cycle assumptions instead of staying near elevated levels, earnings expectations can compress fast. There is also execution risk in restructuring, integration risk with tech, country risk in South Africa and Latin America, labor unrest, currency pressure, and the reality that this remains a high uncertainty cyclical miner with weak long-term excess returns. If commodity prices fall and cost inflation remains high, the thesis can break quickly. For this to work, Anglo must become a genuinely stronger copper-led mining platform. Copper demand from electrification, grids, AI infrastructure, and energy transition spending needs to remain strong. The tech combination must improve scale and production quality. Cost discipline must hold. Success looks like stronger free cash flow, rising returns on capital, cleaner operations, and the market being right that Anglo Tech becomes a premium copper platform rather than just another cyclical miner with a good narrative. This is not a cheap value stock. It is a high-expectation cyclical transformation bet built around copper. That can work for investors who believe copper's scarcity and long-duration industrial demand stay strong and who are comfortable with commodity volatility. But for disciplined investors, the core issue is simple. The business may improve, yet the stock already reflects too much optimism. Anglo American may be getting stronger, but the market is acting like the hard part is already done. I'll break down the next one soon. Subscribe if you want to stay ahead.